We're entering one of those rare phases in history where the economic system does something people misunderstand completely. They call it collapse. They call it crisis. They call it the end of everything. But studying decades of market cycles, analyzing how successful builders navigate downturns, and examining the mathematical patterns behind economic resets reveals a different truth. The economy doesn't crash to destroy. It crashes to reorganize. And this distinction matters more than anything else you'll hear in the coming months. Most people, when they hear warnings about economic downturns, imagine disaster. They see the end of opportunity, the end of growth, the end of their financial security. Their minds immediately go to worst-case scenarios. Unemployment lines stretching around blocks, foreclosed homes sitting empty, retirement accounts evaporating overnight, savings built over decades disappearing in weeks. But here's the paradox that separates those who build wealth from those who watch it disappear. Chaos is one of the most productive forces in the world. If you're prepared, if you understand the mechanics, if you can control your response when everyone around you is losing their minds. Think about nature for a moment. A forest fire clears dead wood so new growth can happen. The flames don't discriminate between the old and the new. They simply create space. The ecosystem doesn't end. It renews. The strongest seeds germinate in the ash-enriched soil. The most resilient species thrive in the newly opened canopy. New plants push through ground that was previously choked by dense undergrowth. In business, downturns do the same thing. They clear out inefficiency. They eliminate weak players who survived on easy credit and abundant capital. They create opportunities for those with capital, patience, and strategic clarity to acquire assets at prices that will never be available again. And the reset approaching 2026, based on current economic indicators, credit cycle analysis, and historical pattern recognition, isn't the end of the economic system as we know it. It's simply another chapter in a system designed to reward the patient, the disciplined, and the long-term thinkers who can see beyond the immediate pain to the structural opportunity being created. Now let's talk about history, because every cycle in the last 100 years has followed the same pattern with remarkable consistency. First comes euphoria. Everyone feels brilliant. Everybody thinks they're rich. Your neighbor is making money in markets they don't understand. Your colleague is flipping houses with no experience in real estate. Your friend is trading cryptocurrency based on tips from social media. Risk feels like a myth, something that happens to other people in other times. Returns feel guaranteed. Complexity is ignored because everything is going up. Portfolios grow by double digits year after year. This is when people start to believe that old rules don't apply anymore, that we've entered a new paradigm where fundamentals are outdated concepts. They start using phrases like, "This time is different," and "the old metrics don't work in this new economy." Then comes detachment from reality. Fundamentals stop mattering completely. Price-to-earnings ratios expand to absurd levels that would have been laughable just years earlier. Companies with no profits, no clear path to profitability, command billion-dollar valuations based purely on narratives and stories. Real estate prices disconnect entirely from rental yields and local income levels. A house that generates $2,000 in monthly rent somehow sells for $800,000, defying all traditional valuation metrics. The data starts whispering warnings. Credit spreads widen as lenders get nervous. Margin debt reaches extremes as investors borrow heavily to juice returns. Insider selling accelerates as company executives cash out at peak prices. But nobody listens because the party is too good, the returns too easy, the social proof too overwhelming. Everyone you know is making money. The news celebrates new millionaires created by market gains. Financial influencers promise easy wealth. And finally comes repricing. Math catches up. Physics reasserts itself. Gravity returns. Liquidity disappears as lenders pull back and investors rush for exits simultaneously. And everything resets to levels that reflect actual value rather than speculative fever. Companies trading at 50 times revenue fall to 5 times revenue. Real estate prices that doubled in 2 years give back those gains in months. This isn't a glitch in the system. This is the system working exactly as designed. This is how markets clear excess, eliminate misallocation, and return to rationality. The dot-com boom provides a perfect example of this cycle. Companies with nothing but a website and a dream were valued at billions. Pets.com spent millions on Super Bowl ads while losing money on every single transaction they processed. Their business model was fundamentally broken, but nobody cared during the euphoria. Amazon's stock fell from $106 to $5.97. That's a 94% decline. Think about that. If you invested $10,000 at the peak, you'd be looking at $600. The Nasdaq Composite dropped 78% from its peak of 5,048 in March 2000 to 1,114 in October 2002. Most internet companies didn't survive. Hundreds of businesses simply disappeared, taking billions in investor capital with them. But the companies with real fundamentals, actual revenue models, customer retention, and long-term strategies used that period to mature and eventually dominated their industries. Amazon survived because, despite the stock price collapse, the underlying business continued growing. Customers kept buying. The infrastructure kept improving. The long-term vision remained intact. The 2008 housing collapse demonstrated the same pattern with even more devastating effect. Fear was everywhere. You couldn't turn on the television without seeing panic. Lehman Brothers, a firm that had survived since 1850, disappeared overnight. Bear Stearns evaporated. Washington Mutual collapsed. Wachovia was absorbed. The S&P 500 fell 57% from October 2007 to March 2009. The entire financial system nearly seized up. Banks stopped lending to each other. Credit markets froze. People thought capitalism itself was ending. Pundits declared the death of free markets. Politicians called for complete restructuring of the financial system. But here's what history shows. Those periods created the foundations for the biggest fortunes of the next era. Companies that maintained strong balance sheets and long-term thinking didn't just survive. They thrived beyond anyone's expectations. The crash didn't delete technology, infrastructure, or customer relationships. It simply cleared out the noise and gave disciplined operators room to acquire assets and market share at unprecedented discounts. Investors who bought stocks in March 2009 saw their portfolios multiply several times over the next decade. Go back even further to the early 1930s. The Great Depression saw the Dow Jones Industrial Average fall 89% from its 1929 peak of 381 to a low of 41 in 1932. Nearly 90% gone. Unemployment reached 25%. 1 in 4 Americans couldn't find work. Despair dominated the headlines. Soup lines stretched for blocks. Families lost everything. But the investors who had capital and discipline during that period, who bought quality assets when everyone else was selling in complete panic, built generational wealth that lasted through their children and grandchildren. John Dearborn Rockefeller reportedly said his fortune was made by buying when blood was running in the streets. That's not just a saying. That's a documented strategy that created one of America's greatest fortunes. Crashes don't delete value from the universe. They simply transfer it from the unprepared to the prepared, from the emotional to the rational, from the short-term speculators to the long-term builders. So let's understand the mechanism behind this transfer. When markets fall, wealth moves from people who react emotionally to people who act intentionally. This transfer happens with mathematical precision every single time, from the impatient to the patient, from the short-term mindset to the long-term builder, From those who follow the crowd to those who follow fundamentals, from those who need liquidity immediately to those who have stored it strategically. This isn't a moral judgment. It's not about good people versus bad people. It's simply a description of how complex systems reorganize under stress. During downturns, quality assets trade at irrational prices that make no logical sense. Companies with strong balance sheets, dominant market positions, essential products, loyal customers, and growing revenue see their stock prices cut in half for no reason other than indiscriminate panic selling. Real estate in prime locations, properties that have been valuable for decades or even centuries, becomes available at discounts that seem impossible during expansion phases. Fear pushes value away from fundamentals, creating gaps between price and intrinsic worth that won't exist once rationality returns. Academic research on behavioral finance consistently shows that fear-driven selling creates mispricing opportunities that can persist for months or even years before reverting to fundamental values. The gap between price and value can be enormous. The winners in these transfers are consistently those who stored liquidity during boom times when everyone else was fully invested and borrowing more to invest even more. Those who studied the competitive landscape methodically, building deep knowledge about industries, companies, and valuation metrics. Those who prepared execution plans based on research and analysis, not guesses, not panic reactions, not crowd-following behavior, not hot tips from friends. They don't need to time the bottom perfectly because nobody can. They just need to be ready when opportunity presents itself at prices dramatically disconnected from long-term value. Now, how do you prepare? There's a framework here, and it has 4 critical components that work together. The first is mindset. This might sound soft, but it's actually the hardest part. Successful investors and operators share a common principle. Stress test your logic before the world tests your emotions. Because when chaos hits, emotion overwhelms reason every single time without exception. Fear becomes contagious like a virus spreading through populations. Panic spreads faster than any actual financial problem. And if you haven't decided in advance who you're going to be, if you haven't made that choice consciously and deliberately, the environment will decide for you. The choice is binary. You're either the reactive investor who sells at the bottom when fear peaks and buys at the top when euphoria peaks, or you're the strategic operator who does the exact opposite. Historical data shows clearly that markets reward clarity, not anxiety. They reward those who can maintain their analytical framework when everyone around them is abandoning theirs and running for exits. Amazon's shareholder letters, for example, consistently emphasize long-term thinking over quarterly results. That philosophy guided the company through the dot-com crash, through the 2008 crisis, through multiple other downturns, and allowed it to emerge stronger each time. The second component is liquidity. Most people think cash is useless during bull markets. They see it sitting there earning maybe 1 or 2% while stocks are up 20 or 30%, and real estate is appreciating 15% annually. They feel like they're missing out. They feel stupid for holding cash. Their friends are getting rich while they're sitting on the sidelines. But this perspective completely misses the strategic function of cash. Cash represents optionality, the ability to act when others cannot. It's potential energy waiting to be converted at optimal moments. During expansions, sophisticated investors accumulate reserves not because they are pessimistic or bearish, but because opportunities arrive precisely when others run out of capacity to deploy capital. Warren Buffett's Berkshire Hathaway typically holds $100 to $150 billion in cash equivalents. That's with a B. Billions. Not because of bearishness, but because of preparedness. Because when opportunities arrive, time 0.3s, they arrive suddenly and disappear quickly. In business and investing, liquidity represents power, the freedom to execute when assets are mispriced, the ability to negotiate from strength rather than desperation. The third component is the plan. Before panic hits, before fear dominates, analytical work must be completed. This means identifying companies solving real problems that will matter in 10 years, not just performing well in the current quarter or year. The criteria should include strong balance sheets with low debt-to-equity ratios, ideally under 30%. High free cash flow generation that gives companies flexibility. Sustainable competitive advantages verified by consistent returns on invested capital above 15%. Pricing power demonstrated through margin stability during past downturns. Network effects or switching costs that protect market position from competitors. Understanding a company's 10-year trajectory requires studying management quality through their track record and decisions, industry structure and whether it favors incumbents or new entrants, technological moats that can't be easily copied, customer retention rates that indicate real value creation. This is analysis that's impossible to conduct properly during market panic, when you're watching your portfolio drop 5% per day. When markets fall 40 or 60%, there's no time for this kind of research. Only time for execution. The plan must already exist, documented in writing, stress-tested against multiple scenarios, ready to implement without hesitation. The fourth component is execution. Market bottoms are only visible in hindsight. Nobody rings a bell. Even sophisticated algorithms and experienced portfolio managers with decades of experience cannot time them precisely. The bottom is only obvious looking backward. But what's possible is this. As fear intensifies in markets, as volatility spikes, as headlines become increasingly apocalyptic, begin accumulating positions. As prices disconnect further from intrinsic value calculations, as the gap between price and worth widens, scale up position sizes proportionally. Use volatility itself as a scaling guide rather than an enemy. When a thoroughly researched stock you understand deeply falls 30% with no fundamental deterioration, no change in the actual business, that's a signal to initiate a position. When it falls 50% and analysts downgrade it and the media writes negative stories, that's a signal to add to your position. When it falls 70% and people question your judgment and friends tell you you're crazy, that's often the signal to add even more if the fundamental thesis remains completely intact. This approach requires discipline more than intelligence. And here's the key insight. Historical analysis across every major downturn in the last century shows that discipline consistently beats intelligence during reset periods. Now let's talk about risk, specifically leverage risk, because this is where most people destroy themselves during downturns. In aerospace engineering, every gram of mass matters. Excess weight isn't just inefficient, it's dangerous to mission success. Too much payload and a rocket can't reach orbit. Too much mass and maneuverability disappears. Too much weight and catastrophic failure becomes probable, even likely. Debt functions identically in financial systems. During bull markets, leverage amplifies returns and creates the illusion of brilliance. A 10% gain becomes 20 or 30% with borrowed capital. You look smart. You feel smart. Your returns beat everyone else's. But when the cycle reverses, and it always does, leverage transforms from amplifier to anchor, from friend to enemy. Forced selling of quality assets at the worst possible prices to meet margin calls or debt covenants destroys wealth permanently. You're selling precisely when you should be buying. The data is absolutely clear across every historical period. Companies with strong balance sheets and low leverage ratios outperform heavily leveraged peers by substantial margins during downturns. The gap can be 50 to 100% difference in returns. Reducing financial obligations before turbulence isn't conservative. It's not being scared. It's strategically advantageous. It's the difference between being a buyer when assets are cheap and being forced to sell when they're cheapest. So what are the signs you should be watching for right now? What should you be monitoring? Complex systems rarely fail without advanced signals. They show stress. They emit warnings through multiple channels if you know where to look. Manufacturing activity measured by PMI indices slows, even as official statements from governments insist everything remains stable and healthy. Consumer confidence surveys show steady deterioration, despite nominal employment numbers that look fine on the surface. Credit card delinquency rates rise to levels not seen since 2008, currently approaching 3.5% according to Federal Reserve data. That means more people can't pay their bills. Commercial real estate shows stress fractures as office buildings sit with 20 to 30% vacancy rates and refinancing becomes impossible at current interest rates. Buildings bought with cheap 3% loans now need to refinance at 7 or 8%, destroying the economics entirely. Liquidity metrics tighten as central banks withdraw quantitative easing programs that added trillions to balance sheets over the past decade. These aren't media narratives designed to generate clicks or scare you into watching more news. They're measurable tremors in the economic system, early indicators that precede larger structural adjustments, leading indicators rather than lagging ones. And right now, multiple indicators are flashing caution signals simultaneously across different sectors and asset classes. This doesn't indicate a single cliff-edge event where everything collapses on Tuesday. Rather, it suggests a sequence, a chain of repricing events across different asset classes and sectors, each clearing inefficiency from the system in waves. That's the nature of economic resets. They're not instantaneous crashes, but processes of rebalancing, repricing, and returning to sustainable levels after periods of unsustainable expansion fueled by cheap money and abundant liquidity. So what survives these periods? What actually gets stronger? Quality companies. Businesses solving essential problems, generating actual profits rather than promises, maintaining dominant market positions, and demonstrating pricing power don't just survive downturns. They use them strategically to gain ground. Amazon, Microsoft, and Google all gained substantial market share during the 2008 to 2009 recession, while competitors contracted or disappeared. They hired talent competitors had to lay off. They invested in infrastructure while others cut back. Strong business models with low debt, high cash generation, and products or services that remain essential regardless of economic conditions consistently outperform during stress periods by massive margins. The key is identifying these characteristics before the downturn arrives, not during it when everyone else is looking at the same data. Prime real estate survives and thrives, not speculative developments in emerging suburbs based on optimistic population projections or projects depending on continued economic growth, but limited supply, high-demand locations that maintain essentiality across cycles. Urban cores in cities with strong, diverse employment bases. Properties adjacent to critical infrastructure like universities, hospitals, government centers. Locations with genuine scarcity constraints, like waterfront or areas with strict zoning. These assets may decline in price during panics, sometimes substantially, but they recover and appreciate over time because the underlying demand drivers remain intact. Precious metals serve a specific function in portfolios. Gold and silver preserve purchasing power when currencies lose discipline, and central banks expand money supplies dramatically to address debt crises. Gold's price rose from $250 per ounce in 2000 to over $1,900 by 2011 as quantitative easing programs expanded globally. This isn't about speculation or getting rich quick. It's about maintaining optionality when paper currency systems face stress. Real technology matters, not hype technology. Companies that demonstrably reduce costs for their customers, increase efficiency measurably, or automate complexity profitably often see accelerating demand during contractions. When businesses face margin pressure and need to cut expenses, they turn to technology for relief and solutions. When efficiency becomes more important than growth at all costs, genuine innovation wins over storytelling. AI infrastructure, cloud computing, and automation platforms may represent this category in the current cycle, but only those with actual revenue models and proven unit economics, not speculative valuations based on future promises, and strategic essentials survive. Energy infrastructure that powers society, food production systems that feed populations, logistics networks that move goods, water utilities that provide necessities. These sectors are unglamorous. They don't make exciting cocktail party conversation, but they're irreplaceable. During every crisis throughout history, markets rediscover what qualifies as essential versus optional. These sectors demonstrate pricing power even in recessions and demand stability even during severe downturns. So here's your action process. 5 clear steps. First, research thoroughly right now while markets are relatively calm. Build deep conviction before panic makes rational analysis impossible. Understand the businesses you want to own. Study their competitive position. Analyze their financial statements. Know their management teams. Second, execute with systematic discipline when opportunities arrive. Follow predetermined plans even when doing so feels uncomfortable or counterintuitive, even when friends think you're crazy. Third, scale positions with fear. As panic deepens and prices fall further below intrinsic value, as the gap widens between what something costs and what it's worth, increase position sizes proportionally according to your plan. Fourth, diversify intelligently. Not randomly across every asset class available, but deliberately across genuinely uncorrelated quality positions that won't all fail for the same reason. Fifth, control your information environment carefully. The most dangerous variable isn't market movement or economic fundamentals, but social pressure and media narratives that trigger emotional responses and cloud judgment. Because here's the truth about human behavior during crises. Fear spreads faster than any financial contagion. Friends, family, financial media all amplify panic because fear triggers evolutionary responses designed for physical threats. Social proof becomes a powerful cognitive trap. Questions will come at you constantly. Why are you buying when everything is falling? Don't you see what's happening? Don't you watch the news? Haven't you heard about the crisis? Your mind will echo their fear because humans evolved to conform to group behavior for survival on the savannah. Being part of the tribe kept you alive. Going against the tribe could get you killed. Don't attempt to convince them during the crisis. Don't engage in debates about your strategy. Don't justify investment decisions publicly during crisis periods. When the storm begins, protect analytical focus like critical infrastructure. Follow data, not narratives. Follow fundamental analysis, not headlines. Follow long-term frameworks carefully constructed during calm periods, not short-term sentiment that changes daily. This is how signal separates from noise during maximum volatility. So let me bring this together into something you can remember and act on. The framework can be summarized in one principle you should write down. Panic destroys more wealth than crashes, and preparation creates more wealth than booms. The coming years will separate 2 distinct groups of people: those who react emotionally to events and those who act deliberately according to plans. Those who get crushed by fear they can't control, and those who accumulate future value at substantial discounts. Economic cycles don't reward intelligence, credentials, degrees, or social status. They reward temperament. The capacity to maintain rationality when irrationality dominates the entire environment around you. Here's what I want you to do tonight. Not subscribe to anything, not follow anyone, not buy any course, but reflect seriously and honestly on your preparation level. Tonight, time 0.3s, and sit down and document 5 assets you believe will matter in the next decade. Not the ones generating excitement currently on social media. Not the ones dominating financial media headlines. Not the ones your friends are talking about, but the ones that will deliver actual value in 2030, in 2035, in 2040, regardless of what happens in 2026 or 2027, or any year in between? Because when fear arrives, and historical patterns across centuries suggest it will, the only plan that survives intact is the one documented before the storm begins. The reset is not a catastrophe to be avoided. It's an invitation to participate in wealth transfer that occurs during every major cycle throughout history. The question isn't whether the cycle will turn. It always does, with mathematical certainty demonstrated across centuries and cultures. The question is straightforward and personal. Will you freeze with the crowd and follow them over the cliff? Or will you execute long-term strategy carefully when opportunity disguises itself as fear? The next chapter of economic history is being written right now, today, in decisions being made by individuals and institutions. Decide right now whether you'll observe it happening to others from the sidelines or participate strategically yourself from a position of preparation and strength.